In this video, I'll tell you everything you need to know about getting and maintaining excellent credit, and we're starting right now. Hey guys, Elliot here. So you're watching this video because you know that having excellent credit is important in today's world, but why exactly? Did someone just make this up years ago and we all follow this unspoken rule blindly? Not really. There are two very specific reasons why. The first one is probably easy to guess. Whether it's a mortgage, auto loan, student loan, or something else, most of us will need to borrow money at some point in our lives. Borrowers with excellent credit will get better rates and save money on interest. It's as simple as that, and for many years this was why everyone tried to maintain a high credit score. The second reason appeared more recently. Fair or not, your credit score is now being used as a judge of character and gets checked if you decide to apply for many types of jobs, as well as when you're renting a place to live. In fact, a bad credit score may keep you from being hired in the fields of law and law enforcement, finance and banking, medicine, engineering, and national defense, or intelligence positions. That's a lot of careers, and they all do credit and background checks. Okay, so hopefully you're convinced having a good credit is important, so let's talk about it and get you all the info you need. And be sure to stick around until the end, where I'll tell you exactly how to repair and improve your credit if it needs a little bit of help. So the first thing we've got to cover are a few important definitions. I probably don't need to spend time defining credit itself. You likely know what that means, but there are four other members of the credit family, and you really need to be able to tell them apart. The first one right here is credit rating, and that is simply an informed professional judgment of your ability to repay debts. The next one is credit worthiness. That is a measure of how you handled debt repayment in the past and how much of a lending risk you are going forward. Then there's credit score. That is a numerical value of your credit worthiness and a predictor of your credit risk. And last but not least, we have the credit report, which is a statement that has information about your credit activity and current situations such as loan history and the status of your credit accounts. Okay, got all that? Great. I have two more definitions for you: revolving credit and installment credit. Revolving credit has a balance that can fluctuate up and down. What is an example of that? If you guess credit cards, you guess correctly. Now with installment credit, on the other hand, the balance typically only goes down, and examples of that include mortgages, auto loans, and student loans. Okay, so you're a credit terminology expert now, and we can really get down to business. And as we do, please be sure to subscribe so I can keep bringing you these personal finance and investing videos. So what you need to know about next are the credit reporting agencies, or the CRAs. Also referred to as the credit bureaus, they are for-profit, publicly traded companies that collect and sell consumer financial data, and yes, that is completely legal. Now, there are three main CRAs out there, and I have a feeling you've heard their names before. They are Experian, TransUnion, and Equifax. There are others out there, but these are quote-unquote the big three. These companies have information on just about every adult in the United States that uses our financial system, as well as information on people from many other countries. Every person's data is packaged in the form of a credit report and sold to anyone who is authorized to look at it, such as lenders. So when you go get a car loan and the bank says, "We need to pull your credit," this is exactly what they go get from the CRAs. So you may be thinking right about now, okay, that was the credit report. What about my credit score? Well, glad you asked. The credit score, which is what so many people focus on, is a bit of a separate story. The original credit scoring model was created way back in the 50s by a company called Fair Isaac. Called the FICO score, it didn't really see widespread use until 1989, but when it did happen, boy did it get popular. See, credit reports can sometimes be kind of long and complicated, and both lenders and consumers wanted a simple way to assess credit worthiness and credit risk, all neatly represented in an easy to understand number, the credit score. For a long time, FICO was the only such score around, but in 2006, the big three RAs got in on the action and created a competitor to FICO called VantageScore, and today these are the two main credit scoring models out there. Both are kind of the same, neither being better or worse, and lenders can use either one to check your credit score. What is important is the actual score and the rating associated with it. Let's take a detailed look because, major disclosure here, you really need to know this. So right here is the FICO score table and the ratings associated with each score range. FICO scale goes from 300 all the way up to 850, and starting from the low end, you can see that anything below 580 is classified as poor, also referred to as subprime, and it's not really where you want to be. You will be considered a very risky borrower and will get terrible interest rates if you ever even get approved improved at all. Going up the scale, you have a fair rating between 580 and 669, followed by a good rating between 670 and 739. A good rating is actually where most US consumers fall, with the national average around 714. Above that, with a range of 740 to 799 is the very good rating, and anything above that, all the way up to the max, is considered excellent. It's actually rather difficult to achieve a perfect FICO score, and it's not really necessary, as you will get the best possible rates once you hit the very good rating. So I mentioned a minute ago there's also the competing VantageScore out there, and it's worth taking a quick look at it. Here it is, and as you can see, it uses the exact same 300 to 850 scale as FICO, but slightly different scale ranges and ratings within it. In the end, same idea. Now here we come to the most important part of learning about credit, and it has to do with what factors make up your credit score. You need to know this because the number one question from everyone is, how do I improve my score? And the answer will become very obvious very soon. By the way, if you like what you're hearing and find it useful, please do smash the like button. It won't improve your credit score, but it will make the YouTube algorithm happy. Okay, let's start with the FICO model first. Here's the breakdown consisting of 5 categories or factors, and what you'll notice right away is that not all factors are equal in weight and therefore importance. 2 of them, your payment history and the amounts owed, are 35 and 30% respectively, and these are the 2 that you need to focus on to get and maintain a high score. So what is payment history? It's simply your history of making payments on time. It's really that easy. Don't be late on any of your loans or your credit card, and just like that, 35% of your FICO score will be perfect. Now what is the amount owed? Another name for that factor is CUR, which stands for credit utilization ratio. This applies mainly to credit cards, indicates the ratio of your balance to your credit limit, or in other words, how much your available credit you are using. This is expressed as a percentage, and as an example, if your credit limit is $10,000 and you have a $5,000 balance owed, then your CUR is 50%. You really want to keep that under 30% and ideally 0. How important is this? So much so that when you make a large payment on your credit card, you will actually see your credit score rise by dozens of points the following month, and of course it can sink by just as much if you suddenly charge thousands on your card and don't pay it off. Now the rest of the factors, while still important, aren't nearly so as the first 2 that we just discussed. Length of credit history at 15% is how long you had various types of credit, with a longer history of course being better. Credit mix at 10% is the different types of credit that you have, such as mortgage, car loan, credit card, etc., with a varied mix being better. And finally, new credit, also 10%, represents new accounts being opened, with you taking a little bit of a hit when you open a new credit line. Now if you're wondering if VantageScore has the same factors, well, it mostly does. Here's the breakdown, and as you can see, it has 6 factors, not 5, but they essentially cover the same thing as FICO. There are some minor differences. For example, the payment history is weighted a little bit more, as is the credit mix, while the credit utilization ratio is rated a bit less. So as you can see from these credit scoring models, you really need to keep an eye on just 2 things. You need to pay your loans on time and never be late, and you shouldn't max out your credit cards. If you follow both rules, odds are your credit score will be at least good, if not very good or excellent. Okay, we're on the home stretch here, and you're gonna want to stick around as I talk about some very valuable credit repair techniques in just another few minutes. Now, a big part of credit is managing it properly. What does that mean? Well, you need to focus on 4 things. In the beginning, of course, you need to establish credit. Then, as part of ongoing effort, you need to maintain, monitor, and protect it. Let's take those one by one real quick, as this is really important. Establishing credit just means creating a positive credit history in the very beginning when you don't really have any. Typically, that is when you just get out of high school or perhaps from starting college. One way to go about establishing credit is to ask your parents to co-sign for a low-limit credit card or perhaps an auto loan, and then of course making sure you always make your payments. If you're already working, open up 1 or 2 lines of credit, maybe a credit card and a gas card, and live within your means so you can pay off anything you borrow. Remember, the goal is to establish a positive credit history, not just any credit history, and you should be able to do this after just a few years of careful credit usage. Now, what does maintaining credit mean? That just refers to upkeep of what you already established. Always try to limit the amount of debt you take on, try to never miss a payment, and keep your credit utilization ratio low. Okay, so what about the last 2 items, monitoring and protecting? Well, monitoring just means keeping an eye on your credit and making sure no errors or false information makes its way into your credit file. Best way to do this is to check your credit report from all 3 CRAs once per year, and you can do this for free through the website annualcreditreport.com. So that was monitoring. Protecting your credit refers to guarding yourself against identity theft. This is when someone steals your critical identifying information information such as your social security number or driver's license number and pairs it up with secondary information such as your name and birth date to open credit accounts under your identity. It's a huge problem which will take an enormous amount of time and effort to fix if thieves are able to open multiple lines of credit under your name. The best cure is prevention, and the best suggestion out there is to freeze your credit with all 3 CRAs. Placing a freeze has been free of charge since 2018, and this action will prevent anyone from opening new credit in your name. To do this, simply go to the websites of all 3 CRAs, Experian.com, TransUnion.com, and Equifax.com, and select Place a Security Freeze. You can keep a freeze in place forever, only unfreezing temporarily when you need to open a new line of credit. This is an extremely important step and one that can save you a lot of headaches down the road. As a matter of fact, if you don't have a freeze in place, pause this video and go do this right now. Go! It'll take 5 minutes and you'll thank me later. Okay, finally, let's talk about credit repair and assistance. Despite your best efforts, problems can sometimes creep into your credit report, and credit repair is the solution. Credit repair is a catch-all phrase that actually encompasses 3 different issues. The first is errors in your credit report, the second is fraudulent items in your credit report, and the third is negative items in your credit report. Let's take a look at all 3 and also give you names of companies who you can hire to help out if needed. So the first one to go over is errors in your credit report. These are unintentional typos, misspellings, and other relatively minor stuff. They are by far the simplest to fix, and all you have to do is file a dispute with the credit bureaus. If the information is incorrect, they can fix it with little effort on your part. This category also includes outdated items or items that should have fallen off your credit report after a set amount of time. Delinquent payments, for example, are removed after 7 years and credit inquiries after 2 years. This process should be automatic, but sometimes things get overlooked, and a clearly articulated dispute filing should take care of the issue. The next category is fraudulent items in your credit report. This, of course, refers to the identity theft that I talked about a minute ago. How do you know this is what happened? Well, you'll be looking at a number of open accounts that you simply don't recognize. Again, the best defense is prevention by freezing your credit, but what if it's too late and you're the victim of identity theft? Here's what you need to do. Go to the website of the Federal Trade Commission or the FTC at identitytheft.gov. They have a step-by-step guide to follow in order to begin the recovery process. It can be a long, frustrating, and potentially expensive one, as you will need to contact creditors from all compromised accounts, and you may also potentially need to deal with collection agencies. Now, there are several companies that specialize in helping with identity theft protection and recovery, including LifeLock, Identity Force, and ID Watchdog. I'm not endorsing these companies, but they are well known in the world of identity theft protection and recovery, and I want you to be aware of them. Finally, we need to talk about negative items in your credit report. This refers to actual earned derogatory marks. In other words, the event in question, such as being 60 days late on a car payment, actually happened, but you may be unhappy about having it on your credit report. So some people do try to file disputes with the CRAs for negative items, but there's little to no chance of removal if the item in question is substantiated. The key word here is substantiated. CRAs have extensive experience with consumers filing disputes just because they don't like what's in their reports. Side note, you definitely did not invent that idea. And they can quickly tell when something is frivolous. You must have clear evidence that the item is false. The rule of thumb is very straightforward. If you know perfectly well that the mark against your credit is legitimate, do not waste your time fighting it with disputes. There are other ways. If it's an actual error or fraud and you can prove it, persevere and you will eventually be successful. So what are these other ways you can repair your credit, and can anyone help you with this? There are a number of credit repair companies out there, and they can take on the tasks repairing your credit for you. Some well-known ones include Sky Blue Credit Repair, Credit Saint, The Credit People, and Lexington Law. Again, I don't necessarily endorse these companies, but just making you aware of them. The big question is, what can they do for you, and can you do it yourself? Credit repair companies can do several things. They can scrub your credit files for inaccurate information, they can file disputes and request information validation. They can also file cease and desist letters with debt collectors, and finally, they can talk with your creditors and negotiate settlements, including asking creditors to remove negative information, which will improve your credit. Basically, if a solution can be reached, credit repair companies will attempt to do so. Now, can you do all this yourself? The answer is yes. Yes, you can. Especially the last one, talking to your creditors. This is really the secret to credit repair, bankruptcy negotiations, really any financial dealings. You talk to your creditors and negotiate. appreciate. Trouble is, most people would rather have a root canal than talk to their credit card. And this is where your credit repair companies step in. You pay them and they'll do all the fun work for you. Okay, I hope you really enjoyed this quick tutorial on all things related to credit and you got a lot out of it. Please do consider subscribing if you haven't yet, and I will see you in the next video.